Screen share. There it goes. All right. So, tonight we'll be focusing our attention on stocks. Okay, we're done with bonds. Now, of course, stocks are a completely different type of security because they represent ownership of a corporation, which means that when you buy stocks, what you're hoping to do is share in the profits of the corporation. Now, of course, over long periods of time, stocks are the best place to make money because, the economy grows over time and stocks will tend to grow as well. Bonds can only provide a specific rate of return based on the coupon payment and possibly some reinvestment income. Whereas with stocks, especially if you pick the right ones, you can actually do quite well in the stock market, as we know from looking at, let's say, Warren Buffett's portfolio. So it's possible to make a lot of money with stocks, but stocks are also very, very risky. They can collapse at a moment's notice. You probably noticed this many times over the last several years. When things are going wrong, stocks can fall very quickly. And that's not going to really be the case with bonds. Bonds are very, very stable. And they're mainly invested in by investors to earn a particular stable rate of return. But stocks are where we hope to make significant rates of return because we're essentially betting on the future direction of the companies that we're buying. Okay. So anyway, what we're going to do here is we're going to look at some institutional details in chapter 10. And then in chapter 11, we're going to be focusing our attention on pricing issues. And along the way, we're also going to briefly take a look at financial statements so that we can help ourselves understand what exactly is driving the price of a stock. So financial statements are set up to show all the most important details about the operations of a corporation, and people who understand how they work will be able to help themselves choose stocks more wisely, let's say, than people who don't understand what's on those financial statements. In fact, Warren Buffett, who I've already mentioned, of course, that's how he makes his money, apparently. He knows those financial statements like the back of his hand, and he's able to glean a lot of extremely useful information out of the numbers that he sees. So what we want to be able to do is at least understand what numbers are on these financial statements and how to interpret them. Anyway, so we're going to be looking at stocks here. Now, of course, most people have the majority of their investments in stocks, and that's a very sensible strategy. Not all of it. I mean, you want to have some money in very safe investments like bonds, let's say, or savings or checking accounts, but you don't want to overdo it because over the long haul, you're going to get a very, very low rate of return from assets like, savings account, checking accounts, even bonds are not going to give the same kind of return you could get with stocks. But having said that, you want to be very careful. You don't just, for example, put all your money into a single stock. You want to have a diversified portfolio of stocks. And we'll discuss this more in chapter 11. But the idea here with owning stocks is that you'd ideally like to hold a very, let's just say, eclectic mix of stocks that have different, for example, they're coming from different industries or maybe have different sizes. Let's say some large companies, some small companies. You want to make sure that you don't have too much of your wealth concentrated into a small number of stocks that are very similar to each other. For example, and by the way, before I forget, this process that I'm describing here is called diversification. Owning assets that are not all affected by the same economic variables. I guess that's as good a definition as any. So in other words, in terms of stocks, owning stocks in different industries. For example, we might have some retail stocks. We could have technology stocks, energy stocks, etc. Now, why is this, by the way? What's the point? Why would you want to diversify your holdings into these different industries? So, holding stocks in a single industry means that an investor's portfolio will experience extremely strong years and some extremely weak years. Say, for example, you have all your money in oil stocks. So, for example, suppose an investor only owns oil stocks. Why? Well, some people would say, well, that's not a terrible idea. I mean, oil stocks have a tendency to do very well over time. But the problem is that, let's say in some years, when oil prices are rising, the portfolio will have a very high rates of return. But in years when oil prices are falling, well, that's a little bit different. The portfolio will likely lose a significant amount of its value. So, in other words, you tend to go through these ups and downs. The portfolio value has some very good years and some really awful years, and so in other words, the portfolio value is very volatile. It changes very quickly and dramatically, or it can change very dramatically from one year to the next, and that makes it hard to plan for the future. If every year your portfolio either gains a great deal or it loses a great deal. So it's probably better to have a portfolio where the returns are more stable, where you don't have these enormous gains and enormous losses. So an investor who holds a diversity of stocks from different sectors of the economy can avoid extreme upturns and downturns in the value of his or her portfolio. And you can see why, because I mean, let's say you have some oil stocks, but you also have retail stocks and you have internet stocks and technology. So in years when the oil prices are dropping, yeah, sure, you might lose money with your oil stocks, but you also have all these other wonderful stocks that might make money and offset a large percentage of those losses. So you're not going to have a case where all your stocks tend to fall or rise at the same time. And using a statistical term, the portfolio with just oil stocks, the returns to the stocks are highly correlated, you say, which increases the risk of the portfolio. In a diversified portfolio, the risk, I mean, the returns to the stocks are not as highly correlated. Because there's a connection between them is much weaker. So they're going to be a little bit more independent of each other. So it's possible to have some stocks that are not doing terribly well, but then there might be others that are offsetting that by having good years of their own and vice versa. So the net effect there is that in a diversified portfolio, the value will be more stable and can still have a very high rate of return. Okay, so in other words, the concept of diversification simply means you're buying stocks from different sectors of the economy with different industries, and maybe sometimes they're coming from different geographical parts of the country. Maybe you have some domestic and foreign stocks. In other words, you want to have different kinds of stocks in your portfolio to make sure that your returns are fairly stable over time. And that strategy will tend to do very well because in spite of the fact that you have a mixture of stocks in there, you're likely to have a strong growth rate on average if you look at a long enough time horizon. So And we'll discuss this in more detail in chapter 11. But for now, it's enough to note that most people do own a significant, or at least some of their assets are held in the form of stocks. And you may notice that if, for example, you have a 401k plan where you work, um, you can invest your money in stocks, but they'll never offer you the opportunity to buy individual stocks. They only offer you funds. And there's a reason for that. They might offer you, for example, a fund of what they call high growth stocks, or a fund of, you know, global stocks, or whatever it happens to be, because they know how this works. They want to make sure that you're not putting all your money into something that's very volatile, which potentially could cause you to lose your retirement money. So they only will offer you funds where you are investing in a huge portfolio of many different kinds of stocks, and you're sharing the returns from the fund. So just check that out. The next time you're looking at, the options that are offered to you in your 401k plan, it's all funds, every one of them. It's just funds. And it's just a question of how aggressive do you want to be. And so you'll know by the titles how aggressive they are and what kinds of stocks they tend to be invested in. Well, anyway, now, of course, there's many other assets to choose from. You can buy, bonds, as we've seen, but bonds, and ideally you should have some bonds in your portfolio because they're safer than stocks. Money market securities, same thing. They're very safe, they're very liquid, but the returns are fairly low. Real estate is a little different because while the returns can be very high, real estate is very illiquid. If you needed to sell it in a hurry, you might run into trouble because it's going to take a while to sell any property that you own, and you're probably going to have to incur a lot of expenses. Now, there are ways, though, you can get around this. There are securities you can buy whose returns are based on real estate prices, so you don't have to actually buy the real estate itself. We're not going to specifically talk about this in the class, but they're called REITs, real estate investment trusts. And what they do is they put together investors' money and they buy real estate. And so when you buy a share in one of these REITs, what you're essentially doing is collecting a share of the returns, meaning the mortgage payments or the rent, whatever it happens to be. So this way you can invest a relatively small amount in real estate, but it would be easy to sell a REIT if you felt so inclined. So that way it's a little bit easier, but still real estate itself is very illiquid. Anyway, so a share of stock is partial ownership of the corporation. You're literally a partial owner, depending on what percentage you own. Now, of course, if you don't own a huge percentage of the outstanding stocks, you don't have a whole lot of influence over the running of the company. But you do get these large shareholders who own significant percentages of the outstanding shares, and they do have a lot of influence over how the company is run. In fact, sometimes that's why they buy these stocks, so that they can, maybe improve the management or something like that. And in fact, so actually, sometimes you hear about one company buying out another. What they're basically doing is they're buying up all the shares of stock, and so sometimes you have these friendly mergers between companies, and sometimes you have hostile takeovers. But what effectively is happening is if one company wants to buy out another, they're going to offer all the shareholders a relatively higher price than what the stocks are worth in order to sell to the potential new owners. So, but the bottom line is when you own a share of stock, you have voting rights, you have the right to collect dividends if there are any, and the value of your investment will grow with the company. Now, the other nice thing about stocks is that they're highly liquid. It's easy to buy and sell them, unless the stock is from a very, very small company. And you may have heard this term before, penny stocks. They're stocks whose prices are really low, like $1 or even less. Penny stocks are extremely inexpensive. And they would typically be the stocks of very small companies. So, but But here's the thing, they can be a good investment because imagine yourself buying a $1 penny stock and some positive event causes the price to go up 50 cents. You just made a 50% rate of return. So for some people, penny stocks are actually a pretty good deal. Um, but they may be hard to find. They may be hard to buy. There may not be any real demand for them in the market. So it might be tricky to sell them or to buy them. They're probably going to be fairly illiquid compared to the stocks of larger corporations. So they're inexpensive, but they're also less liquid than the stocks of larger corporations. Okay. Now, of course, as I've mentioned this before, over time, stocks have consistently provided the highest return of all financial assets in the United States. Now, of course, over time means several years. So, in other words, people have to be patient when they buy stocks. Unfortunately, a lot of people will sell stocks when the prices are falling because they're worried that they'll keep falling. And maybe they're right, but um, others would say, listen, if stock prices are falling, maybe you should buy more of them so that when the price comes back, you'll really have a nice rate of return. So stock prices can be very volatile, but on average, they do tend to do better than other financial assets in the United States and all other countries too. Now, you can buy stocks through an exchange, the most famous one in the world being the New York Stock Exchange. And this is where traders are literally standing on the floor buying and selling stocks for their clients. If you wanted to buy 100 shares of Apple, for example, your order might go down to the floor of the New York Stock Exchange, where somebody will fill it at the lowest possible price. But that's kind of going the way of CDs, I guess, because a lot of trading now is done electronically. There's not a lot of human intervention. So, but it used to be that's how it was done. They would stand there and yell at each other, and they would write down prices, and they would execute orders. So the New York Stock Exchange still is the most famous, but there's many regional exchanges as well. And maybe we could find a quick list of them. So, for example, we have, okay, so these are ones that are, not maybe as large or famous as New York Stock Exchange, but we have the Boston Stock Exchange. Chicago, these are actually derivatives exchanges. So that one really shouldn't be in there, I guess, but Chicago Stock, National Stock Pacific, Philadelphia Stock Exchange, so there are others. But of course, the New York Stock Exchange is by far the most famous. And so um, now I think we already maybe have started to have this discussion, primary versus secondary markets. So the way it works is that when a corporation needs to raise money, large amounts of money, and they decide to issue shares of stock, they don't do it themselves. They don't have the expertise. So what they do is they hire an investment bank who acts as what's called an underwriter. And the underwriter's job is to sell the shares of the corporation for the highest possible price. So what they'll do is sometimes they'll just simply buy up the shares themselves and then resell them to their own clients. Or sometimes they simply guarantee a price, or sometimes they just help sell the stocks. But a corporation normally doesn't do this themselves. They do hire that investment bank. And if it's the first time that they're issuing shares of stock, it has a special name called an IPO, initial public offering. First time that a corporation issues shares of stock. It's kind of an exciting moment in the history of the company because this is when they've really arrived. They're now trading on one of the big stock exchanges. Everybody knows who they are. It also raises a lot of money in a hurry. And sometimes it's the best way to find out how much investors think the company is really worth. You see, whenever there's an IPO, there's a lot of excitement, a lot of activity. And, if you buy these shares on the first day that they're issued, they can often go up quite considerably in a very short period of time. And so it's a very popular form of investment to grab shares of an IPO and hope that they go up very, very quickly. But it doesn't always work out that way. In fact, Facebook's IPO was very disappointing. And so people didn't do very well when they from Facebook's IPO. Now, of course, if they held their shares, they would have made a lot of money. But IPOs attract a lot of attention. There's often a lot of hype about the new company and what they're going to do in the future. So, if people have money to gamble, often will buy IPOs and hope that the price will just go through the roof, which does happen sometimes. In fact, I'm sure we can find an article about the most successful IPOs in recent history. Well, the 10 largest. Okay, well, okay, let's look at that for a second. This doesn't necessarily mean they were successful. Saudi Aramco, that's obviously an oil company, raised $25.6 billion in December of 2019. Alibaba, 22 billion rather. Movies and some of these others. Wow. So, but sometimes, like people will buy these IPO shares and the price will go up and up, and then all of a sudden, when the IPO is done, the prices start falling again if the investors are not convinced that this is sustainable. So, it's a very risky thing to do to buy into these IPOs. You don't know what's going to happen. I think the problem is with Facebook's IPO here. Yeah, all right. Well, oh, here we go. Initially, the stock went up to $45, but the early rally was unsustainable. It struggled to stay above the IPO price for the day, forcing underwriters to buy back some of the shares to support the price. Um, at the closing bell, they were down to 38.23. Uh, so, in other words, if you bought one of these shares, you made 23 cents. So the investors weren't that crazy about it, but the IPO raised $16 billion for Facebook. And that was the point of it. So this is what we mean by the primary market, where the funds actually go into the pockets of the corporation. After that, those shares that are out there will get sold among investors to each other, and they will not raise any more funds for the corporation. And that is what we mean by the secondary market. Okay, so if I pick up the phone now and decide to call a broker and order Facebook stock, it's not going to put any money in Facebook's pockets, just the person who sold it to me. So yeah, you can see the pattern of prices. It started at 38. Now, usually the IPO comes out at a specific price because they're not absolutely sure how much people are willing to pay for that stock. And then if people want to pay more, the price will go up. And then all of a sudden, oh my God, look at this. I didn't realize it started at 38. By 68 days later, it was down to $20. But then a couple years later, it was up to 55. So, and people who held on, who were very patient, did end up doing extremely well. And I can see why, though. It was suddenly listed on the S&P 500. That's a big deal. That gives them a lot of name recognition. A lot more investors are going to take them seriously, and so the price went up to 55.12. Wow. So you don't get it, IPOs don't happen very frequently, but what's interesting is that if you are ever in the New York City Wall Street district, on the day that an IPO is happening, if you walk past the New York Stock Exchange, there'll be posters all over the place promoting it. like they want you to know that this exciting IPO is going on. And it's, I guess, they want they don't actually give things away, but um, there's a very festive atmosphere down there. In fact, we could probably find a picture of one. All right, here's an example. So there's the traders in the inside. Once in my lifetime, I actually got to go inside the New York Stock Exchange and trading for. It took a lot, and I mean a lot of string pulling. And it wasn't just me, it was a group. Somebody had apparently had some real connections, but I have done it once. It's very impressive, um, but it's very, very difficult. So this is what it normally looks like. The New York Stock Exchange on the outside. It's got the big flag there. At Christmas time, they get a tree in there, and they do other things. But um, oh, I thought I saw a picture of an IPO. Hmm. Oh, well, you can kind of see it over here. It's a little tricky because it's way over on the side. Yeah. But it's just basically posters on the, they want you to know whose IPO is going on. Yeah, I guess we're not going to find another one. And that just means for the first time, this company's stocks are trading, are publicly trading. So, that happens when the company's really getting to the point where they need a lot of new capital in a hurry, where they can't just keep raising it from banks, or they can't get it from angel investors, like on the Shark Tank show. That those are angel investors. It's a good way for a company to gain get some capital, but it's not. It's going to come a point where it's not nearly enough, and so that's when they turn to the stock market. Oh, well, I guess I'm going to have to give up on looking for that picture. And of course, there's a lot of large stock exchanges. It's not just the New York Stock Exchange. The Nasdaq has always been an electronic only exchange. If you went in there, you would not see anybody trading because it's an electronic exchange. And of course, the Nasdaq was originally, and probably still to a certain degree, almost exclusively high tech companies that are listed on it. But then we also have the London Stock Exchange and the Toronto Stock Exchange. Chicago is where you get a lot of not just stock, there is a stock exchange there, but they also have derivatives exchanges, which we'll discuss later on in the course. Now, at the other extreme, companies that are just too small to be listed on it, like the New York Stock Exchange, for example, where do you buy those stocks? Like the penny stocks that I just mentioned. Well, for those you have trading directly between market makers or dealers. They have a small inventory of these stocks, and they're willing to buy and sell, and they make their money from a bid ask spread, where they buy the stocks at a relatively low price and resell them at a relatively high price. And so, like, if I want a penny stock and it's not available on any exchange, this is how I'm going to have to get it. And it might take a while to find the shares that somebody's willing to sell me. This is a very can be a very illiquid market. And so that's called the over-the-counter market. So now imagine now all stocks have a bid and ask spread, but they're going to be quite a bit wider on these small stocks in the over-the-counter market. But the amount of the bid-ask spread will also depend on the size of the transaction. So if you're buying 1,000 shares of a stock, you'll get a very narrow bid-ask spread. If you're buying a share, it's going to be much wider. Okay, because the market maker is trying to make money. So you're going to make a small transaction, they're not going to turn you away, but they will charge you a higher price as a result. or they'll offer you a lower price to buy your stock. So if you ran into this situation where Apple, which I guess it's higher than this, but this is telling me that if I want to buy Apple stock, I pay 122. If I want to sell it, I'll get 120. And so the bid ask spread is $2. The one on the left is the bid price, the one on the right is the ask price. You have the same thing with foreign currencies. If you've ever traveled abroad, you'll notice that when you go to the window, you'll see quotes, two quotes for every currency, and it's the same thing. It's a bid and ask spread. So they'll offer to buy it from you for a fairly low price and sell it to you for a very high price. So if you're interested in British pounds, for example, let's say you're heading off to London for a vacation or something, and you don't have any pounds in your pocket, you might go up to the foreign exchange window in one of these are typically done at commercial banks in the city. And although there are dealers that only deal in foreign exchange, and so you might run up and look at the sign and it'll say, well, want pounds. So it's going to be a fairly wide spread between the two. So you will be paid $1.18 for each pound you give them for dollars. But on the right-hand side, you can see you have to pay $1.30 for each pound that you're buying for your trip. There's a big difference between the two, and that's where their profits are coming from. Now you might say, well, I don't want to pay that. Well, then you're not going to get your pounds. So what you could do, by the way, is wait till you get to London and use your credit card. Apparently, that's the cheapest way to buy foreign exchange. Because most of the, if you have a card issued by a commercial bank, most commercial banks do trade foreign exchange, and they can get it for you at a relatively low price. In fact, it's interesting. If you ever you come back from a trip where you were buying things with a foreign currency, if you look in your credit card statement, you'll see that they've calculated the exchange rate like a large number of digits of accuracy, surprisingly. Not like 2 or 3, but it could be 10 or 12, because they're in the market, and so they know the exact price at which they can buy or sell these currencies. Well, anyway, so we have electronic networks that are designed to take the place of traders, basically. They also make it possible to trade overnight, because the New York Stock Exchange closes at 4 o'clock, sorry, 4:30. They're open from 9:30 to 4. And once they close, that's it. No more trading until the next business day. But you do notice trading does take place overnight. And so it could be happening in foreign countries. There could be these electronic networks going on. But we also, I think I mentioned this once before, have futures trading going on in foreign markets during the evening hours. So like here, if you look at these CNBC, the markets closed a couple of hours ago. So now they're going to show you futures prices. So this means that somewhere, probably in Asia, futures contracts are being traded on the Dow, Standard Poor's 500, the Nasdaq, and at the moment they're down a little, which means traders in the overseas markets are seeing pessimism about the stock market. Now that doesn't necessarily mean that tomorrow there will be losses, but right now, with trading that's happening at this moment, this is what we're seeing. Over here, you notice how sometimes they list the price. This is this is a barrel of crude oil. I'm sure they could tell us exactly how they define that. There's different kinds of crude oil, but and over here, this is the yield on a U.S. 10-year Treasury note. Well, anyway, so you have these electronic networks that are meant for larger. Some of them are meant for large institutional investors. Some of them are meant for us, the little guy. You may have heard of some of these. Stock quotes. Now, if you want to know what's going on with the stock, now it used to be that people would carry around newspapers, the Wall Street Journal, they'd have it open and on the train, but these quotes are still available, and you can see that there's a lot of information enclosed here. what they're showing you here is during the trading day, the price of the stock got as high as 62.10. It was as low as 49.40. There's a dividend of $1, and that implies a yield of 2% because that means that when the stock dividend was declared, the price would have been about $50. You can tell because 1 out of 50 is 2%. Now, here's an interesting number, and we'll see more of this later on when we look at financial statements. PE means price earnings ratio. That's the ratio of the price of the stock to what are called earnings per share. Just quickly go over that. And again, we'll see this later on with the financial statements, but at the end of each year, after all of a corporation's expenses have been paid, including taxes, what's left over to the corporation for a corporation are known as earnings or sometimes net income. So after all expenses have been paid, the remaining funds available to the corporation from its sales revenues, that is, are known as earnings. So in other words, if you take all your revenues, all the money you earn by selling your product, subtract off all the expenses and the taxes, whatever's left over at the end of the year is called either net income or earnings. So EPS, earnings per share, refers to the ratio of net income or earnings to the number of shares outstanding. So just as a quick numerical example, if a corporation has $10 million of net income or earnings, 1 million shares of stock, well then, clearly EPS will be $10 per share. So in principle, the company could issue a $10 dividend to every shareholder if they felt so inclined. Not that they're going to, but that's possible. That's how much wealth has been earned for each shareholder during the year. Now, if no dividends are paid out, these funds are reinvested in the company and are known as retained earnings. So companies are involved in a lot of research and development, will have a lot of retained earnings. Some others may not be doing a lot of research, a lot of innovating, new products, that type of thing, and they may pay out larger dividends. Like, companies that are growing rapidly will typically not pay retained earnings because it's too important to reinvest the funds in their current operations to increase their growth as quickly as possible. But old line companies that have been around forever, very stable earnings, they're much more likely to pay dividends. Okay. Because they may not have as many exciting projects to invest in. And so they're thinking as well, if we don't have anything to invest it in, why not just pay it out to the shareholders? It is, after all, their money. So, so earnings per share is simply how much is available to pay out as dividends per each share of stock. Anyway, the volume of trading, the closing price, the net change from the day before. So this information helps us understand what kind of a day the stock had. And let's see, so I think, yeah, we get this. Now, P ratios fluctuate over time, and they rise as the economy gets stronger. Because when the economy is stronger, people are more likely to buy stocks, and that pushes the prices up. So the PE ratios tend to rise. PE ratios also tend to be very high for companies with an awful lot of earnings potential. So you might find, let's really start. Let's look at a couple of different companies. Let's try a stable line company like Coca-Cola. One that's been around for the growth, they're not going to grow like crazy in the future. They'll have a nice steady income stream. They'll pay dividends to their investors, but they're not going to suddenly increase their sales by 50% next year either. And they're not likely to bring out any spectacular new products that nobody's ever seen before, like Apple money. So their PE ratio will be relatively low. That's strange. It's not listed here. Why not? Well, that's pretty disappointing. Let's try another stable company like Procter and Gamble. Oh, for God's sakes. I have to look at their stock ticker symbol. Oh, I forgot to ask for their symbol, ticker symbol. EG. Oh, I guess that makes sense. Right, so let's go look at their price earnings ratio. It's not there. You know what? I don't know. There might, maybe it's because it's after hours. I guess what kind of waste of our time there with this. Maybe some other time we'll see if we can find these numbers. I don't know what's going on with that. That's I have to assume that that's what the problem is. But anyway, the bottom line is the PE ratio tend to be relatively low for stable companies like Procter & Gamble, Coca-Cola, and much higher for the very risky companies where people are convinced that they're going to make a lot of money in the future. Like you might still find very high PE ratios for Amazon, for example, even though they've been around for a while. There's still a lot of upside potential. Or Apple or any other companies that produce very high tech products. NVIDIA, for example, probably has a very high PE ratio. Trading volume, well, some companies, the famous companies have very high volumes of trading. The closing price, that's when the bell rings. The last price of the day is considered to be the closing price. Okay. By the way, you know what that reminds me? I wanted to mention something interesting here. You're probably wondering about the word ticker symbol. You notice that every one of these stocks has a symbol of some kind. It's just a couple of letters typically. For example, the ticker symbol of Apple is AAPL. Now, none of these ticker symbols is really long or messy. They're fairly simple and straightforward. So you're probably wondering, what are they for? Where did they come from? Well, now that brings us back into the history of finance about 100 years ago. And this is the kind of thing you could have learned about at the Museum of American Finance if it was still there. Um, the, Back in the day, we're talking about the 20s now, um, there were no computers. So how did people know what the stock prices were for each stock? How did traders get their hands on this information? Well, it was this newfangled invention, which is essentially the internet of the day. Uh, let's see, there we go. You may have seen one of these in the museum. And these, now, by the way, these were connected to each other by underground cables, like telegraphs or that kind of thing. So I don't know how to make this any bigger. Oh, wait, no, that's not too bad. So it's a little mechanical device, and what would happen is somebody out there would find out what the stock's price was, and they would submit it, I think through Morse code maybe, and it would print itself out on this little ribbon of paper basically. And there wasn't a whole lot of room on that little, this is ticker tape. There wasn't a whole lot of space on there. So how were they supposed to tell you what company they were talking about? Well, they came up with these symbols. And so you would look at the ticker tape, and maybe we can get a picture of actual ticker tape. Um, Here we go. So you can see like FBR is selling at 29 and a quarter. FBS is selling for 19 and a quarter, et cetera, et cetera. So this is how you would find out what the prices were for all these different stocks. And so if the company's name was really long, it would have wasted a lot of this ticker tape. And so we couldn't have that. So they came up with these abbreviations to make it quick and easy to identify which stock we were looking at and what its price is. It also made it possible for people to, like traders, to memorize these names so that they could see in a hurry, oh, what happened to this stock? And of course, the ticker tape, once it was printed out, had no value to anyone. So when there were parades down Broadway, people throw it out the window like confetti. That's how they came to be known as ticker tape parades. How do you like that? And if you notice too, the prices of these stocks are quoted as in fractions, like 2.10 and a quarter. That means $2.10.25. They were using I'm sorry, fractions. And that didn't stop until like 20, 30 years ago. It took a long time to completely decimalize US stock prices. All right, anyway, that's our history lesson for today. Um, Now, you don't normally, you can't buy a stock directly yourself. You can't just call Apple and say, please sell me some shares of stock. You need a broker, an online broker, whatever it happens to be, but it's still a broker. And they take responsibility for getting your shares of stock. Um, and they charge a fee for it, of course. Now, some brokers charge huge fees, but they're giving you a lot of services. They're offering you research, they're offering you advice, they're offering you the ability to buy a lot of uh, assets that might not be easy to find anywhere else. For example, if you want foreign stocks or something, um, if you go to like a Charles Schwab, they're going to offer you all these services. Now they're constantly advertising on TV these days. They're promoting themselves. I mean, they're like that cut rate guy who they show in the commercial. Probably doesn't have a fraction of their services. But you in the real world, in practice, the cut rate guy probably also has very low fees. But the premise of the commercials is that Schwab has everything that you want, and so why don't you go there? But they will charge a larger fee for every transaction. They're called full service brokers. A place like Robinhood, which you just get online and buy stocks, is a discount broker, which means that you're on your own. I mean, if you need advice, if you need research, if you need anything like that, they're probably not going to offer it to you, but you're not paying for it either. So that's the trade-off. Analysts, yes, analysts. There's an army of analysts working at Wall Street whose only job is to analyze the individual stocks and come up with recommendations for investors or for their own company. Like you'll have a financial institution that has a portfolio manager who's buying stocks, and one day he might say, well, I don't know if I should buy any more Apple stock. And he'll call up the Apple analyst and say, listen, what do you know about Apple? What's going on over there? And the analyst is the one who's intimately familiar with all the dealings of Apple and can make a recommendation to the portfolio manager. And the portfolio manager has to, make the decision. But the analyst is the one who's responsible for knowing everything there is to know about that stock so that you can make an informed decision. So now, every type of financial institution does this a little differently. There are companies that are called buy side, where they buy stocks for their clients' portfolios, and then there's the sell side where they're selling stocks. Um, and they all do things a little bit differently. Now, order types, there's actually more than one way of buying stocks. A market order simply means you go into your account and say, listen, get me 100 shares of Apple, and they're going to go out and find it at whatever price the price happens to be on that day. But you can also set up what's called a limit order. So if, for example, you're interested in Apple, let's just find out what Apple is selling for today. It's about 199. Okay, great. So suppose you place an order where you say, listen, I want you to buy me a share of Apple stock, but I don't want you to pay more than, let's say, $198 for it. That's known as a limit order. It means that the order will not be executed unless or until price falls below 198. Now, the good thing about that is it can be somewhat. The bad thing is that there's no guarantee that it will ever be executed. So in other words, what if the price never goes back down to 198? Then you'll never get your shares. It works the same with selling. I can say, listen, I want to sell a share of Apple stock, but I won't accept less than $200. Same problem. It might help me earn more money, but my trade may never get executed either. So those are two of the more common types of um, orders you might see placed in the marketplace. There's others too, but those are the most common ones. Okay, online, now we already know about this. Robinhood in particular, they let you trade online with low fees, low minimum transactions, low minimum balances. Now, what's happening, depending on the broker, I guess if you have money in their account that you haven't used to buy stocks, they should pay you interest on it, probably tied to whatever's going on in the treasury market. Otherwise, you won't leave your money there and you won't have it available to buy shares of stock when need arises. Now, of course, the online brokers like Robinhood do not provide investment advice, they don't give you recommendations. So you're on your own. If you're willing to do your own research, fine. I mean, so everybody has to make the decision for themselves. Now, buying stock at margin, this is interesting. Depending on, what broker you're doing business with, you may be able to buy stock at margin, which means you're basically buying it on credit. But now you're not literally charging charging it. But what you may be able to get away with is like, listen, I want to buy some Apple stock, let's say $10,000 worth of Apple stock. But the broker offers you the opportunity to only pay 5,000 now and the rest later on. Why would you do that? Because what you might be thinking about doing is letting the stock go up if it goes up quickly, you can sell it at a profit without ever putting up the other $5,000. And what that does is it greatly increases your rate of return compared to paying the full price today. Now, of course, the drawback to this is that there's a lot of credit risk involved. So, you're not going to be able to do this unless you're in a really good position financially, or if you're well known to your broker, or you have an excellent credit rating or whatever. But it is possible to do this. So under some conditions. Now, the problem with it, though, is that while you can magnify your gains, it could also magnify your losses. All right. So it's a very risky thing to do, but it is possible. Now, this is something, short selling stock. This is not as common as it once was. There are other ways of betting on the stock price going down, but what this enables you to do is you can actually borrow shares of stock that you don't own from your broker, and you can sell them, and then you promise to replace them in the future. So your goal is to buy them back after the price has gone down. Okay. And if that happens, you can make some nice money. The problem is that the price goes up, you could really get hammered. So it's a very risky strategy, very risky. And of course, and again, you're not going to be able to do this unless you have excellent credit rating, excellent reputation, and the whole nine yards. But it is one way you can take advantage of the belief that a stock price is heading down, besides selling your own shares. Okay. All right, now collateral is maybe required for a transaction like this, which means you put up property, you pledge property that can be seized if you do not repay or return the shares of stock. Okay, so collateral makes a loan less risky, but if you put up collateral for a loan and you don't pay it back, you could lose your collateral. Now, analyzing stocks, obviously the whole point of buying a stock is to make money as their profits increase over time. So the point is to buy it at a low price and sell it at a high price, or in other words, to earn capital gains. Now, how do you analyze shares? Well, there's a lot of different approaches, but they do fall into one of two basic camps. Fundamental analysis, where you're looking at the economic factors that affect it, and technical, where you're basically only focusing on the stock's past history. So fundamental analysis means you're looking at you're looking at the financial statements, basically. You're looking at the revenues, the costs that they face, the profits that they've earned in the past, all the things that really matter to the profitability of the corporation. You're also looking at economic variables too, macroeconomic variables like GDP growth, interest rates, inflation, unemployment, you name it, monetary policy, all of that refers to fundamental analysis. So let's say, for example, you're thinking about buying Apple stock. Among the many other factors you might consider is your belief as to how much Apple sales will grow in the future. Do you think they're bringing out exciting new products, or do you think they're just going to play it safe? Are they going to take advantage of AI or not? Will they be able to continue building their products in China? There's so many things that could affect the stock price. But those are all fundamental factors. They are economic variables that directly impact on the profitability of the company. And other things too, like this, the size of the market, like how many people are out there buying Macs? How much competition do they have? What new products are they bringing out? What kind of, you know how it is with Apple now. Every fall, everyone expects to have a new iPhone in their hands. What kind of features will it have? Will it be any kind of an improvement? Or will it be just more of the same? So there's all kinds of things they have to consider. Now here, I was able to get my hands on a link. This is still finance.yahoo.com, but if you know where to look under analysis, what they're showing me here is these are analysts. These are the Apple analysts. Every one of these financial institutions has an Apple analyst, or at least one. A person who, like I said, whose own job is to make themselves specialists in everything about the Apple company. And they have their own opinions about where it's going. And so what they've done here is they've kind of put together the rankings from these guys. This is what you and I are really interested in. So like buy, strong buy, outperform. I'm pretty sure they mean outperform the overall market, overweight, hold, neutral. Those are their recommendations. And over here, if you notice, there's a price target. This is what they're expecting to see in the future. They're looking pretty good, except this one is 210. That's neutral. And then, I mean, that's not very much, but it's free. If you want more than this, you're going to have to start up a subscription. But so the analysts will provide their opinions about, the stock's performance, and you may want to take that into account when you make your decisions. Now, technical analysis is completely different. What they're doing is they're looking at the history of that stock's price, and they can derive all kinds of information from it. Like, imagine you're looking at Apple. Well, actually, it's right here. Where are we? Let's go back here. Look at there. Ah, here we go. All right. Now, I'm not sure this website is working right now. It may not do other. All right. So let's go back. Let's say 6 months. Huh, that's interesting. It's kind of floating around. What did I hear? Date. Ah, well, no, it's kind of flat. 5 years. It should be. All right. This is good. So, what the technical analysts are going to say, listen, look at this chart. What does this tell us? Where is this going? And so they're essentially trying to extract trends from the past into the future, saying, well, look at this. Doesn't this suggest that it's going to keep going down? Look at that slope, it's very steep. Or over here, what does this tell us? So they have all these rules that they developed to help them identify patterns that will help them figure out where the stock is going in the future. There's not one bit of attention paid to fundamental factors like economic growth or GDP growth or earnings or new products. It's just where's this variable been in the past? Where is it going in the future? There are websites out there where we can look at this in more detail. Um, I think I actually found one the other. Yeah, here we go. Let's see. Oh no, that's sorry. That's fundamental. I, yeah, well, the bottom line is they look at charts, lots of charts. See what they got here. I see they don't have any actual graphs here. That's kind of unfortunate. Maybe I can find something. Oops. All right, well, I lost it. If I did, I know. Maybe these guys. I don't think so. Oh, barchart.com. That sounds like a promising one. No. Well, I mean, they have the numbers, but I wanted to see a graph. I think it was skipper out of it seeing a graph. Um, this might be good. Um, Mm. All right. Well, now we're getting somewhere. So like this chart right here, you see what they've done is they've got a couple of these trend lines going on. They've got a long-term green one and short-term red one. And they're using that to point towards where they think the stock is going. AAPL has a bad technical rating, but it does show a decent setup pattern. We see reduced volatility while prices have been consolidating in the most recent period. There's a support zone below the current price, 193. This is a little outdated. Stop or loss order could be placed below this zone. So that's how they're analyzing it. But these lines basically. Hmm. But there's no mention here about, their products or the state of the economy. It's just what's going on with these numbers, with these charts. Now, some would say, now, by the way, I've spoken to people who actually are traders, and a lot of people agree that the two approaches aren't necessarily mutually exclusive. The In the short run, meaning like within the same trading day, technical analysis can actually be very successful, especially when there's something going on in the markets, where, for example, there's some bad news for Apple and the price starts falling. If it starts falling in the first thing in the morning, it'll probably continue all day. But you start looking at longer time frames, like even a few days or a week, then you really need to focus your attention on fundamental analysis. So um, I've never been a trader, so I don't know about this from personal experience, but they did say that there are times when technical analysis can be very helpful, um, but if you're looking at any longer time frame, then you're probably better off with fundamental analysis. God, there's so many indicators. Every one of these can be interpreted differently, and every one of them is based on the past history of Apple stock. And then we've got all of these graphs. Oh my God, look at them. I don't know if they're willing to show us these graphs. Oh, here we go. I didn't realize this was going to happen. Um, so look at how you've got these candlesticks, they're called, and they're showing us the pattern of Apple stock. They're showing us the trends, retracements, all this stuff. And they're saying this is where we think it's going. Okay. So anyway, so you get the idea. This is an interesting chart. Hmm. Make a note of that somewhere. And if in case I ever need to show anyone an example again. All right. Now, analyzing a firm's financial condition. So let's forget about technical analysis. Let's go back to fundamental. Where are you going to get that data from? Now, if you're looking at the company itself, this is where you're going to get all the information you need. If you're looking at the economy, well, that's different. You might be looking at GDP growth, et cetera. You can get all that information from Fred, but you have to understand how it's affecting your company. So you really have to understand what the company does, what kind of industry they're in, um, what kind of problems they have, what kind of challenges, where are things going right, where are they going wrong. But all the data about the company that you need to analyze it are coming from primarily these two financial statements called the balance sheet and the income statement. Now, these are all publicly available. You can go get them online. All corporations in the US are required to file this with the SEC every year. So it's publicly available information. There's no secrets here. There better not be any secrets, so they're going to be in trouble. So I have posted in Brightspace. I forgot all about it, but I put it there earlier today in the folder for chapter 10. in Brightspace, if you go look, you'll see this file called here it is. Financial statements, of course. What else would I call it? So this is a fictional corporation that doesn't really exist. And I just wanted to organize it in the same way that anyone else's financial statements would be organized. Now, of course, they're all different. There's things that are unique to each company, but pretty much the basic organization is the same for everyone. So now the balance sheets show us the relationship between what are called assets and liabilities. Now, of course, assets are uh, represent anything a corporation owns, and liabilities are the debts of the corporation. Now, of course, you're hoping that the assets are greater than the liabilities. The difference between the assets and liabilities is known as equity. Okay, this represents the value to the shareholders. So the word equity means ownership. So, for example, it's like if you have a house, let's say you bought $1 million house with an $800,000 mortgage. That means that you put up the other 200,000. You have $200,000 worth of equity in that house, which grows over time as you pay off the mortgage. So equity means the value of the assets minus the liabilities. Whatever's left over is what belongs to the shareholders. If that number is negative, of course, then that means the company is bankrupt. But they're hoping that assets are greater than liabilities. And so we have them all organized here. On the left, this is the normal setup. We have assets. Now, normally assets are subdivided into short-term or current and long-term. What separates the two of them is basically the useful lifetime of those assets or their liquidity. You could think of it. For example, over here, if you notice in the current asset category with cash, which we could spend at a moment's notice, accounts receivable. What is that? Well, if you've already had an accounting class, you know what that means. Accounts receivable are short-term debts that are owed to a corporation. For example, if Apple sells $1 billion worth of computers to the US government, promises to pay for them on, let's say, I don't know, July 1st, before payment is received, dollars is an asset known as an accounts receivable. Okay, no, because sometimes when a corporation makes large sales, like to their vendors or suppliers, whatever, they don't necessarily collect the money right away. At the retail level, certainly they do. But if, let's say, a farmer sells crops to, supermarket chains, which is their biggest customer, they'll typically give them time to pay for those crops. And so while they're waiting for the money to arrive, those funds are referred to as accounts receivable. So they're an asset, just like any other. Now, interestingly enough, um, it is actually possible to sell accounts receivable to financial institutions. So in other words, you can do this. For example, what happens once in a while is, um, or maybe a hedge fund, for example, or some kind of financial institution, they often buy what are called credit card receivables, which means they the bank that issued the cards isn't sure they're ever going to get the money. So they say, listen, we'll sell you these receivables at a discount and you try to collect them now. Okay. So accounts receivable are the same. It is actually possible to sell your accounts receivable to a financial institution and get some money up front that maybe less than you would have gotten if you'd waited, but then you get the money right away. Okay, so accounts receivable are a type of asset, a very short-term asset, because these are typically due very soon, within less than a year. Inventory, everyone knows what that is. Those are the products that you've built, but you haven't sold yet. Now, some companies don't actually have any kind of inventory. These are service companies, don't have like an inventory as such. Like, let's say you are a corporation that writes software for clients. You don't have an inventory as such. You just provide a service for which you get paid. But if you are a manufacturer, let's say, or a retailer, let's say, then you're probably at any given time going to have a lot of inventory, which is the products that you will sell, but you haven't sold just yet. So these are known as assets too. And by the way, you can sometimes sell your inventory to others without selling them directly to the public. This could be anything else, other current assets. So we add them up, and then we have long-term assets whose properties are very different. So short-term or current assets have the one thing in common, are very liquid. You can dispose of them in a hurry if we need cash, let's say. Just like you may not be aware of it, but if you have a student loan, the financial institution that gave you the money, it's possible that without your being aware of it, they've sold your loan to somebody else. They do that sometimes just to raise money. So let's say you owe $50,000 and they don't want to wait for it. They might sell it to another financial institution at a discounted price to get more money into their pockets today. And you might not even know about it. It does happen. Mortgages too. A mortgage on a house can get sold to another financial institution without you ever being any the wiser. Sometimes you find out, but sometimes you don't. So assets can be sold depending on what they are. Sometimes it's very easy, sometimes it's not. Now, long-term assets, though, are not only not liquid and are usually used in the operations of a company. Okay, so what would that be? That would be, this includes land, buildings, equipment, machinery, computers, et cetera, vehicles. So let's say we're a publishing house. Long-term assets might include buildings which they operate. They own them, that is. And the computers used to produce their books, magazines. So these are assets that you wouldn't normally sell because you need them to run your business. But these are very illiquid. So if you really needed to unload some of your buildings or your land, it's going to take a long time to sell it. So we have land, buildings, plant and equipment, this is like basically what you're using to produce your goods and services. It's a very general category. Um, Plant and equipment used to produce goods and services. Let's say, for example, a Starbucks plant and equipment would include things like blenders, coffee bean binders, espresso machines, that kind of thing. Ice makers. This is the kind of stuff they need to actually run the business. Or just coffee urns. Those it's even though they're machines. Depreciation, by the way, the word depreciation, you run into this with cars. Depreciation refers to reduction in value of long-term assets over time. Like your car, the more you drive it, the less valuable it becomes. Time goes by, put mileage on it, it loses value. Now, of course, from the corporation's perspective, this is a problem, but it's tax deductible, so that's a good thing. And then you have all these other ones. We don't have to go through every single one of them. Now, over here on the liability side, we also have to break these up into current or short-term and long-term. So current liabilities are due usually within a year. And that would include things like, there you go, accounts payable. These are short-term debts that will be repaid typically within a year. Like, for example, what if you run a business that uses a lot of Xerox paper? You're constantly making copies. So you have a standing order to have them deliver 100 reams of paper in the first of every month. Then you pay for it at the end of the month. So between the time that the paper arrives at your office and you pay the bill at the end of the month, that's considered to be an accounts payable. It means you have the merchandise, the materials, you owe the money, and you will pay it back real soon, but not just yet. Okay. So that's pretty normal for most businesses. They don't tend to pay for things the minute they receive them. They often are allowed to pay for them with a fair amount of time. The vendors don't want to upset them. They don't want to set their best customers. So they'll say, well, you can pay for it at the end of the month if you want. Then we have notes payable. Notes are basically very short-term bonds. Like, a matter of months, maybe even a year, issued by corporations. You may have heard of an example would be commercial paper, which has a maximum maturity of 270 days. This is for short-term money. Let's say the corporation needs to fix plumbing or something, and they don't have the money on hand. So they might issue commercial paper to pay for it. And then when they get the money in from their normal business operations, then they'll pay it back. Oh, what did I say here? 270 days. So yeah, or they could go to the bank too, I guess. But this is meant to cover very short-term expenses. Now, current portion of long-term debt, that means now virtually all corporations have some outstanding bonds. As we saw last week, most corporations issue some corporate bonds to raise funds. They need to run the business. Now, as you know, these corporate bonds will provide a stream of coupon payments to the investors and eventually repayment of the face value. The coupons and face value that are due within a year are known as the current portion of long-term debt. And those just the amount that's due very soon. So now the company, of course, has to be very careful. They have to plan for all this. They have to make sure that, these short-term debts are covered when they come due. So they can't just say, well, their bonds, we'll pay for them eventually. They have to pay the short-term debt when it comes due. So they'll have to be very careful not to run out of money. And then you got other stuff, and then long-term liability. These are debts that are due more than, let's say, typically it's defined as more than a year in the future, but it might be a lot more than that. For example, the classic example, corporate bonds typically have maturities of 10, 20, or 30 years. So they would be considered long-term liabilities. Okay. What else do we have? The deferred taxes. These are taxes that we owe, but we haven't paid yet. So we add them all up. So we have assets on the left. Now in this example, the total assets are worth 177 this year. Total liabilities are 155.50. So the difference between the two is what we call shareholders' equity or simply equity, and that's 2220. Okay. That means that the value of the company to the owners is right there, 2220. So it's like as an individual, if you added up all your assets and you subtracted off all the debts you have, whatever's left over is your equity, which hopefully is positive. That could be thought of as your lifetime savings, I suppose. So now if you notice, these two sides always equal each other. So assets always equal liabilities plus equity. It's one of the rare equations that you might actually run into in accounting, but it's an important one. Okay, well now that's the balance sheet. So the thing the balance sheet is shows the financial condition of the corporation at a given point in time. Now, the next financial statement we want to look at is the so-called income statement. Now, this is completely different. The income statement shows how a corporation's earnings or net income are calculated. So it's showing you how this number came about. At the end of the year, when they say their earnings are this is how they figured it out. So this will be a typical corporation's income statement. We start with total sales or total revenues. Well, actually, I shouldn't say from all sources. You can have other kinds of income that are not sales. So from the sale of the corporation's profit products during the year. You might have other, like occasionally you get like the company might sell off a piece of land that it owns and earns a nice little profit. That goes into a separate category because it's a one-time only type of thing. But this is their sales. Now, cost of goods sold. This is an interesting category. Think of it as the cost of producing the corporation's profits, but it doesn't include everything. It's a specific type of cost. For example, let me just show you an example. For Starbucks, the cost of goods sold would include coffee beans, milk, sugar, nutmeg, cinnamon, cups, lids, um, those little sleeves that keep it from burning your hand, um, etc. Those only the things that are actually used to make their products go into this category. In economics, these are sometimes known as variable costs, if you've had economics, meaning that if you didn't sell any merchandise, you would not incur any of these costs. Okay. So this is an important detail, but it's not the only kind of expense you're going to have, is it? No. You also have, and this can have a lot of different names: selling, general, and administrative costs. Sometimes it's called overhead. Um, the costs that are not directly associated with the production of goods and services, sometimes known as fixed costs. These are the things you have to pay. Um, these expenses are independent of the quantity that we sell of our product. So at a Starbucks, and for everybody for that matter, include rent. I mean, if they own their own, don't own their own buildings, then there's going to be rent involved, property taxes, fees, salaries, up to a point at least. You got to pay your managers, for example, even if you don't sell a single cup of coffee, insurance. God, what else? I'm sure there's other things that I'm not thinking of. Okay, so that's the rest. These are the things that are behind the scenes expenses. Then, you might have research and development. It depends on the company. Obviously, Apple will spend a fortune on that. Starbucks, maybe. They probably are working on new flavors. They occasionally bring out some new type of coffee, and you don't see it last very long typically. But the companies do need to at least try to expand their offerings to survive. You don't want people to get tired of what you're doing. Like if you notice, McDonald's is always tinkering with their menu. There's always something going on. Either there's some new ingenious way of bundling together their products, or else they have something new that they're trying out on the public. Like they just brought out something the other day. I just saw that somewhere. Um, what is it? But sometimes they don't always do this throughout the entire country either. It can be done on a regional basis. April 8th, they introduced Hershey's S'mores Fluff McFlurry. Okay. Um, all right. Now this one I never heard anything about. Squishmallows Happy Meal. I don't know what that means. I know what a Happy Meal is, but I don't know what this is supposed to be. Oh, lemonade. No kidding. Wow. Now, of course, they don't expect all these products to do equally well. They may end up keeping some of them. They may not. All American Games Happy Meal, Oreo Shamrock McFlurry. Look at that. I never heard of that. That one. That's a lot for 1 year. Dulce de leche frappe. Yeah, and so most of these fell, but some of them will stick around. Smoky BLT quarter pounder. So in other words, they're spending money researching these products to see if there are things that maybe they could add to their menu that people might like. I'll tell you what I'm annoyed about. Before the COVID, they used to have nice salads and they never brought them back. And I don't know why. You'd think that they would at least try to have something healthy. But I also thought they'd come back when the COVID was on. And I never did find out why. Well, now that I'm thinking about it. Oh, here we go. Somebody else wondered about the same thing. Oh, okay. So I guess what they're saying is that they didn't sell as well as I know, you figured that it would be easy to have salads, but I guess not. They've been serving salads, yeah. See, um, uh, I guess that means they're not coming back. All right. Well, anyway, enough of that. Oh, yes, let's get back to our statement. So then you have research and development depreciation. Now, at this point, if you subtract, you take your total sales minus the cost of goods sold. This number is called gross profit. Okay. Then you start subtracting off the other types of expenses, like selling in general, admin, research and development, depreciation. And this leads us to something called operating income. And then if there, by some chance, there's some other unusual form of income, like I said, selling of land or something, then you put that here. Then this number is called earnings before interest and taxes. Then you figure out the interest on your bonds. Now, the reason why it falls here is because this is tax deductible. And then this is called earnings before taxes. Then that's where the taxes are determined. And then, so here's your net income. Now, if you notice, 162 is your net income, but our sales are 186.70. What happened? Well, most of that got swallowed up by expenses. So the ratio of these two, by the way, is called your profit margin, your net profit margin. And this number can be quite small for some industries. Like in the fast food business, it could be 2-3%. I mean, really small numbers. And so, like, if you took the ratio of 162 to 186.70, now, of course, remember, I made these numbers up, but still, that is not that unusual. This is less than 1%. All right, so that seems a little low. But if you were to look up this number for, let's say, a McDonald's, we should be able to look it up on finance.yahoo.com. You can see it'll just be a very small percentage. You can come down here and look under Apple. By the way, the information that I'm showing you here is available on finance.yahoo.com. Let's get it. If you look over here under financials, Yeah, so you can see there's our income statement, there's our balance sheet. This statement of cash flows. This is just another way of organizing the same information. The dividend statement, for some reason, is locked. That means you have to pay for it. But also up here, if you look under statistics, you sort of have a lot of these important financial ratios that are derived directly from this financial statement. So one of them would be like our earnings ratio, for example. So they're, they're, they're I thought that, yeah, I don't know why these numbers are blank. Yeah, it might be because trading's over for the day, but you could tip, usually you can look up their net profit margin. You know, we could probably just go to the internet, say, what is a normal profit margin for McDonald's? Net profit margin. Ah, there we go. They're happy to tell us. Said, I don't think they're referring to the same thing. I think that might be gross profit margin. That's what, no, there's no way. No, they're doing something different. Um, anyway, so that in a nutshell is what we're going to find as financial statements. Okay. So, like I said, this here you're just organizing the information a little differently. There's some financial ratios here that you can derive from that information. One that we're just discussing is the net profit margin. We do have the earnings per share, um, return on equity, which is a rate of return to investors. Uh, there's all kinds of ratios. If you're really analyzing a company properly, you really are going to have access to all these amazing ratios, but you know your job is to make sense out of them. See, debt to equity. This tells me how much debt the corporation has compared to the amount of stock they have, and so these ratios tend to depend on what kind of industry you're in. You know, heavy manufacturing companies tend to have a lot of debt. Service companies, computer companies tend to have a lot less debt. Um, Here it is, net profit margin. So this fictional company has a net profit margin of about 1%. Okay. So that means they have a lot of expenses. And so the stock market analysts would see that as a red flag and probably not recommend that you buy this stock. Maybe they have too many expenses. All right. So anyway, so we can skip over this. Now, and as I mentioned before, the net income that's left over at the end of the year, there's really only two things that can be done with it. Um, Not, I shouldn't say that, but that's the majority of the time. Net income typically is either paid out as dividends or reinvested in the company in the form of what are known as retained earnings. That's what that phrase means, retained earnings. They're the company's own earnings that they haven't distributed to the shareholders. Now, you might think the shareholders would be upset by that. Um, Shareholders might prefer that the corporation reinvest its earnings in itself, since this can lead to more rapid growth in the future. Like Apple, I mean, imagine if they decide one year to say, listen, I said, we're tired of developing a new iPhone every year. We've got a good one. Let's just sit on our laurels and let's let it go at that. Well, that's going to cause problems because it means that in the future, the competition will start to take away some of their market share, and the company will not only not grow as much, but they might even start to shrink. So by constantly innovating and creating new products, even if it's just newer versions of their same products, that is what helps the company grow. So if this leads to more rapid growth in the future, which in turn leads to higher stock prices. So in other words, investors are happy about that. This is what they're aiming for. Most of the time, investors in stocks are looking for large capital gains. If they want dividends, if they want current income, they probably would be better off with bonds anyway. So most corporations do not pay out a large amount of dividends for that reason. They usually have opportunities to invest in their future and grow more quickly as a result. So this is what investors like to see, especially high-tech companies. Like right now, all these AI companies, you can rest assured they are not paying dividends. Why would they? All right. Now here's a couple of this is just a couple of other ways in which funds can be raised. Private equity, this would be like the Shark Tank kind of thing, where like you go on the TV show and you need $100,000, and the sharks sit there and they offer you like $100,000 for X% of your company. Those are the relatively early days. Okay. There's other possibilities like crowdfunding, means you're raising it on the internet. IPOs. Now, IPOs means you're ready to actually issue stocks. Okay. So anyway, so that's chapter in a nutshell. Now, in 11, our focus is going to be very different. We're going to try to figure out what it is that drives the price of a stock, which it's a very complex question. Bonds are easy to price, but stocks are a lot trickier. A lot of price of a stock comes from psychology, really, and expectations of future earnings, for example, or when there's bad news in the market, it could affect stocks very dramatically. Whereas bonds, unless there's a risk of bankruptcy, the coupons are fixed, their yields are stable. It's easy to price bonds, much easier than pricing stocks. So many different models have been created over the years to try to price stocks, obviously, because if you do a good job creating a stock pricing model, you can make a lot of money with it. So we're going to look at some of the more basic approaches to pricing stocks and also measuring the risk of a stock. A stock obviously is very risky. It's nice to have the ability to measure their risk. Like last week with the duration measure, stocks have their own risk measure, which is known as beta. You may have heard of it. I could show you some off of, well, I'm afraid that they're just not showing us any information right now. Let's see if I can at least find out it's beta, and then we'll figure out what it means. No, it's not there. I don't know what's going on here. All right, so chapter 11 is stock valuation and risk. Stock valuation methods. Now, some of these actually do involve calculating present values, but again, the problem is that the cash flows are uncertain. Not only that, but here's an interesting thing to think about. A bond has a finite lifetime. A stock does not. The stock lasts as long as the corporation is still around. So if you bought a share of Coca-Cola in the 1890s when they first came out, it would still be a valid share of stock. There's no time frame for stocks don't mature. So that makes it even more complicated to price them compared to bonds. But the information we need to price them does ultimately come from the financial statements. Yeah, so here's a summary of the reasons why it's more difficult to price stocks than bonds. For one thing, the cash flows are much more uncertain. Stocks have an infinite lifetime, and the discount rate is very, very different. With bonds, Um, I don't think we mentioned this last time, but the yield to maturity of a bond really depends on two things. It depends on the credit rating and on the maturity of the bond. So if you look at all the 30-year corporate bonds in the marketplace, you might discover that all the AA bonds have the yield of, let's say, 8%. All the triple B bonds have the yield of 10. They all, almost without fail, all the bonds in that same category have the same yield because it refers to the amount of risk involved. So it's easy to figure out the yield of a bond if you know the credit rating and the maturity date. With a stock, they're all completely unique. Each case is different. So one stock, you might discount the cash flows at 8%, at another stock it might be 10, another it might be 12. So that makes things even more difficult. And to make things even worse, these discount rates depend on market psychology, okay, up to a point, because if people are nervous about a company, the discount rate will go up, even if there's nothing wrong with that company. So there's a lot of challenges here, a lot of challenges. So we're going to look at a few commonly used approaches to pricing them. The one that I think you'll find the most interesting down here is the capital asset pricing. And this is where we derive that risk measure called beta, by the way. And just as a little side note, a little historical footnote, the developers of the capital asset pricing model were eventually awarded the Nobel Prize in economics, which shows how important it turned out to be. Okay, so I guess it's almost 8 o'clock. So why don't we stop here and come back in our usual half an hour. And so around, let's say 8:20-ish, we'll come back and we'll dive into these stock and valuation methods. Okay, so I'll see you in a while. Uh, okay, so now we're going to focus our attention on pricing methods. So we start with the so-called price earnings method. So basically, what this is all about is we're looking at the price earnings ratio of a stock. And this is kind of a shortcut thing. You know, sometimes some of these pricing models are not all that sophisticated. What they have you do here is take your earnings per share and, look at whatever industry your company is in and average out all the price earnings ratios across the board and then multiply it out. I mean, it's not terribly sophisticated, but sometimes if you don't have a whole lot of information about a company, this is the best that you can do. Or if it's a new company that, just got started and there's very little information about it. So let's say an oil company is expected to have an earnings per share of $5 a year per share this year, and the average PE ratio in the industry is 15, that means a projected stock price of $75 a share. So it's a very simple technique. Now, of course, it's based on a lot of very strong assumptions. They're assuming that the growth of the earnings of this company will match those of the competitors in the same industry. And but on the other hand, who knows if their earnings will actually be $5. If you notice, this is a forecast. It might just be that this is what they earned last year and they're just projecting it ahead one more year. But so it's a quick first guess at what the stock price might be in the coming year. Now, this is interesting because this part, what we're about to do, kind of resembles what we did with the bonds last time, which is to say that we are looking at the future cash flows and discounting them by some rate of interest, which in the case of bonds is the bonds yield to maturity. That yield to maturity, as we've seen, depends very heavily on the maturity of the bond and the credit rating. And it's almost uncanny. Like if you look in the market, how yields of all these different bonds with the same credit rating are virtually identical to each other. So here, everything is different. Every single stock is likely to have a different discount rate. But the thing about the stocks, though, is that the only cash flows that you might actually receive on a periodic basis are dividends. Now, I mentioned, I think once before, that dividends are typically declared. By the way, dividends, if a corporation does issue dividends, it's because they were declared by the board of directors. Okay, so the corporation's directors is technically in charge of the company. Um, they're responsible for carrying out corporate policy. They set direction for the company. They they also hire the senior management typically, and then they let the senior managers hire everyone else. And the CEO, of course, is chosen by this group. Is to, if you're applying for a job as a CEO, you're going to be interviewed by the board of directors. Now, the board of directors themselves aren't necessarily the major stockholders. They could be anyone who was chosen by the company to help run the show. In fact, sometimes you see these corporations have members that are there because they're famous in some important way, or sometimes it might be somebody who used to be at the Fed, one of the Fed governors, or, there's a lot of ways in which you could be appointed to the board of directors. But ultimately, the shareholders have a say in this. In fact, when the shareholders vote, this is one of the things they're voting on, the members of the board of directors. So if the shareholders are very unhappy, when they have their meeting every year, they can vote out the board of directors and replace them with somebody else. So the directors actually report directly to the shareholders, and but they choose the people who actually run the company on a daily basis. The directors aren't there very often. They get together every so often and they have meetings and then they make decisions, but they're not the ones who actually run the company. That's where the CEO comes in. So the board of directors are setting the general tone of the company. They're setting corporate policy. They're choosing the managers to carry it out. But one of the things they do is decide whether or not there should be a dividend. Okay, so the board of directors also sets or chooses the company's dividend policies, it's called. And so each quarter, the board of directors may declare a dividend or decide not to pay a dividend at all. Depends on the company, but they have to be careful because let's say that, oh, and by the way, these dividends are never legally required. It's things not like coupon payments on bonds. Dividends are 100% optional. The corporations are not ever required to pay dividends, but those dividends can affect the perception of how well the company is doing. So what's happened in the past is companies have actually borrowed money to pay dividends that they couldn't afford just to avoid tipping off the public that something's wrong. It has happened. So they're going to be careful. They probably will pay, if they've been paying a dividend in the past, they'll probably continue that same dividend or possibly even increase it slightly, unless there's really a problem. Like if they have to suddenly say, we can't afford a dividend this quarter, the stock price might fall, quite a bit because that sends a signal to the market that there's something wrong at this company. So they have to keep an eye on investors in the marketplace when they decide what to do about dividends. It's a tricky tightrope that they have to walk. But many corporations, like I've said, do not ever pay dividends. They prefer to reinvest the dividends, the cash flows, I mean, into their own operations. And the ones who do pay dividends tend to be very consistent about it. Like Coca-Cola that I mentioned the other day. They pay dividends. They've never missed a dividend payment for over 100 years since the company first came into being in the 1890s. If they ever declared one day, you know what, we don't have the money for a dividend, it would mean something catastrophic must have happened at Coca-Cola. So that's not going to happen. They don't want that to happen. So, but the directors are the ones who decide what dividends to pay. Now, if they do pay them, they're going to come out every quarter. That's the norm for U.S. corporations. So a company like Coca-Cola that does actually pay dividends, those are the cash flows. Those are the ones that we know about. For the owner of the stock, the only other way you can make money realistically is for the price to go up, which means you're earning capital gains. Now, occasionally, let me just mention this in passing, very occasionally, this is a rare occasion, but I tell you, a corporation may declare a stock dividend, which means everybody who has shares of stock already will get another X number of shares as a reward for holding the stock. But the dividends we're referring to here are cash dividends. But that is another potentially source of income to investors. Capital gains, cash dividends, and very, very, very occasionally stock dividends. So the models we're about to look at are based on the idea that the dividends themselves are being paid on a consistent basis. And so dividend discount model that we're looking at assumes that dividends are paid on a regular basis and that the present value of all future dividends used to value stock. Okay, just like in a way, you can see the parallels with bond pricing. The bond, of course, are calculating the present value of all the remaining coupons and the face value, but the difference being that those payments are required, whereas here they're not. Okay, so there's going to be a lot of uncertainty here. Having said that, though, these are very popular models. So we're going to try this right now and see how this works. So here's the basic model. Now, I'd like to draw your attention to the fact that this last dividend has a time or an exponent of infinity. Let's make it a little bigger so you can see it. Because there is no specific lifetime for a stock. The corporation, as long as the corporation continues to exist, um, the stock will still be valid. And so, in principle, there's potentially an infinite number of dividends in the future of a corporation. Who knows how long it'll last? So this is the model that we're using now. If you notice, the dividends are indexed by the time at which they're received. P0, by the way, this is the current price. When we use time subscripts, we normally let 0 represent the current time. And 1, for example, means possibly next year, but it might also mean next quarter or next month. That depends on the context. So the rest of them occur in the future. So the price, and oh, and by the way, R is the discount rate. It has multiple alternative names that mean the same thing. Sometimes it's called the cost of equity. So that number reflects the risk of the stock. And that's the tricky part because that depends on everyone's opinions about how risky the stock is. Whereas the yields in the market are, easier to estimate. Let's put it that way. Well, now it's not, of course, mathematically, it's not possible to calculate the present value of an infinite number of dividends. You literally take the rest of eternity to do that. So there are ways that we can shorten this up a bit. So what we have to do here is basically make an assumption. Oh, yeah. One of the other names for this is the required return. Sometimes it's even called the hurdle rate. Why it's called that? Because you can think of it as the minimum return that investors will accept to own this stock. Okay, so just as a quick example, suppose that this is a very risky company. What can be thought of as the threshold or minimum rate that investors will accept in exchange for buying stock. So in other words, this is a terribly risky company, and R is 15%. The investors must reasonably expect to earn 15% rate of return stock. If not, well, then they'll sell it or they won't buy it. Okay. So this is the number that we use to discount the cash flows because it reflects the risk of all those future cash flows. Now, yeah, so like I was starting to say, we can't actually calculate the present value of dividends that occur in the infinite number of periods in the future. So we have to make assumptions about what's called the investment horizon. This is the time frame over which investors, um, I guess, are investing for. I mean, well, that's a terrible definition. Um, let's say investors expect to hold financial assets. So let's say, just like a quick example, if an investor is saving for retirement and expects to retire for years, then his or her investment horizon is obviously 30 years. Let's say you've got somebody else who's much older and is going to retire in 5 years. Well, then their investment horizon would be 5 years. Or you may have somebody who's simply saving for their children's college, and they're going to be in college in 10 years. So they would have a 10-year investment horizon. So that's going to influence the types of assets that we buy. Um, just in general, investors with longer time horizons tend to buy riskier assets because often they provide a higher rate of return on average. So if retirement is not for 30 years, you can take chances. All right. So if something goes wrong next year, well, fine. You've got 29 more years until retirement. Whereas if you're retiring in 5 years, you better not lose any money. You don't have that much time to make it back. So this is why. So for this reason, investors with very long time horizons hold a very large percentage of their funds in stocks. And very little bonds. Investors with very short time horizons, of course, are the opposite. Will do the opposite. Right. In fact, it gets to a point where maybe you've got all your money it's just in the bank or something. It really ultimately comes down to risk. So the models can be adapted for any investment horizon. So, for example, let's just keep things simple. Let's look at what we would call a one-period investment model. So now that R is meant to represent the rate of return to our share of stock, or we could also think of it as the return on equity or the expected or required return on equity. In other words, this is the threshold amount of return that we need to buy a share of stock. Now, this formula is telling me that the return itself comes from two sources: the dividend. Now, this is my capital gain if it's positive. And of course, capital loss if negative. And then this is the initial price of the stock. So in the numerator, we have the dollar return to the stock. Divided by the initial purchase price, it becomes the percentage return. Okay, and that's our rate of return. Okay, so that's what we're really after, the percentage, which is because this way we can compare our returns to among all the different potential stocks we can buy. The dollar return depends on, among other things, the initial price of the stock. It doesn't tell us a whole lot. Like if I tell you I made $10 from a stock, it's hard to tell if that's a good return or not until I tell you what I paid for it. All right, so if you're going to sell the stock after one period, this is your model. Now look how simple this is. P0, the current price of the stock, is therefore D1, next year's dividend, and P1 is the price at which we expect to sell the stock next year. Both of these are discounted by 1 plus R. There's an implied 1 here, by the way. This is occur 1 year in the future. The exponent is 1. And that's it. So, for example, we have a share of XYZ stock selling for $50 today. The dividend is $2, and we expect to be able to sell it for $55 in 1 year. That implies a current price of 52.78 if our return required return is 8%. Now that's where it gets interesting. I'm an investor. I see the stock is pretty risky. I don't really want to hold it unless I can pretty much count on getting an 8% rate of return. That implies a price of 52.78. Should I buy it? Well, now I can look in the market and say, well, if the price is 50, I better buy it because that means it's a bargain. Okay. If I buy the stock, I think it's worth, I mean, the market says that it's worth 50. I think it's worth 52.78, or at least from my perspective, it's worth 52.78. So that means I'm going to buy it. But on the other hand, somebody else who is really terribly worried about risk and they expect a 16 or require 16% return to own the stock, would perceive the stock as being worth 49.14. The market price is 50. They're not only not going to buy it, but if they already own it, they're going to sell it. They consider it to be overvalued in the market. Whereas here, they consider it to be undervalued. So the logic here is that investors, if they're smart, will buy any asset that they consider to be undervalued and sell any asset that they consider to be overvalued. Not only that, but I mean, when you think about it, this investor needs to buy the stock from somebody who thinks that it's overvalued. And so this investor might buy it from this investor. And they're both happy because this investor thinks that it's too cheap. This one thinks it's too expensive. And so they'll be happy to trade with each other. Okay, now who's right and who's wrong? Well, that remains to be seen until we watch the price in the future. So now, by the way, this brings up an interesting point. I just want to mention this before I completely forget about it. All investors have different risk preferences, we're going to call them. Some are extremely averse to risk, and some aren't so worried about it at all. We assume that all investors are risk averse. It simply means that they must be compensated with higher expected return in exchange for bearing risk. So in other words, if these stocks were paying the same return as treasury bonds, then nobody would bother buying stocks. They would just put all their money in treasury bonds because they're safe. Why would you even consider buying a share of stock unless there's some realistic expectation that it will do even better than treasury bonds? So in other words, nobody will buy any asset in the economy unless they expect the return will be enough to justify the risk they're taking. Now, having said that, some investors are more risk averse than others. It may depend on their income or how old you are, what you do for a living. It may just be that some people are just nervous about risk and some people aren't nervous about it. So in the example we just looked at, this investor is much more risk averse than this one because they have that higher expected rate of return or required return to own the stock. Or maybe they know something about the stock that these guys don't know, but we're assuming here, we're assuming that there's none of that going on, that everyone has the same information. Now, if you're going to consider hold your stock for 2 periods, well, this is the model we had a minute ago. P1 could be extended out to period 2. When you combine these, this is the 2-period model. So you've got 2 years worth of cash flows coming in. The first year is simply the dividend. Second year, you're getting a dividend and you're selling the stock for P2. And if you notice in the denominator, the exponents reflect the time at which you receive our cash flows. So it's a little bit messier, and then you can push this out as many years as you want. So we can have an H period model where we have H dividends, each discounted by that required rate of return. And then in year H, whenever that is, we also have the discounted value of the price at which we expect to sell it. Now, by the way, this model is maybe more general than it looks. You could, in principle, have zeros for some of these dividends because, let's say you expect the corporation to sometimes miss a payment. You could actually put any pattern of dividends into this model. Now, there's some special cases, though, that prove to be very important. One of them is the case where the company doesn't grow at all. Therefore, the dividends are stable. Constant growth, which means the growth rate of the dividends is equal to that constant growth rate. And then we also have cases where the growth is not constant. But even then, in these models, there's a tendency to assume that often assume that in the early days of corporation, the growth rate of their earnings, their profits, and therefore their dividends is very high. And this tends to level off as the corporation matures. When the company's brand new and exciting, they're involved in all the newest products, everyone's still learning about them. Their growth rate could be very high, but eventually, as people become accustomed to the company, the growth will level off, and then it'll be very stable from that point on. So you can imagine in the early days of Coca-Cola, for example, it was so new and exciting that their growth rate was probably very rapid. Now, everybody in the planet has Coca-Cola. Every country has already got Coca-Cola. There's not that much room for growth anymore. So whatever their growth rate is, it'll be very low and it'll be very stable. On the other hand, when you have a brand new company, some of these AI companies, who knows what might happen in the future? The potential growth is beyond belief. And so they'll likely have very high growth rates in the early days until they settle in and become stable and more mature, and the products have more predictable demand and that type of thing. So anyway, so let's take a look at the consequences of these assumptions. So if we have no growth, then all the future dividends will be equal to each other. All right. And therefore, this infinite period model plays with this one. And now remember, I did mention this the other day. When we're talking about bonds, we introduced the concept of perpetuity. Perpetuity is a security. It pays a fixed amount per year. There's no other ways of making money. You're going to get a fixed income amount. If it's a bond, you're getting a coupon. If it's a stock, you're getting a dividend, and that never changes. In the case of the bond, there's no face value being paid back. So a stock with fixed dividend could be thought of as a perpetuity because it provides the same cash flows every year forever. End of story. So the pricing model is crazy simple. Now remember, the bond, it was C over R. Now it's D over R. Okay. D is the fixed dividend, and R is the required return. And so the price is D over R. Now, there does exist a class of stocks. Most stocks are what we call common stocks. And when you hear stocks discussed, it doesn't say otherwise. They're talking about common stocks. There's also a class of stocks which not every corporation issues, known as preferred stocks. Now, these do not provide voting rights, and their growth opportunities are limited. But if a corporation does not have enough money to pay the dividend that they've offered, to all the shareholders, um, the preferred shareholders must be compensated by receiving future earnings to by receiving future earnings. In other words, if the company falls behind with the dividends to the preferred shareholders, they have to eventually catch up with them. They must somewhere down the road pay all the dividends. Whereas if you have common stock and they announce that we don't have any money for dividends, that's it. You're out of luck. You just don't get any. So the preferred shareholders are basically guaranteed, as long as the company can do this, to get dividends, whereas the common shareholders are not. So that means that dividends received by the preferred shareholders are more stable, predictable, and therefore preferred stocks can be treated as perpetuities. Certainly have an infinite lifetime. And that's one area where bonds, more normal bonds, do not have an infinite lifetime. And therefore, the pricing model is just this. It's so simple. Okay. So preferred stocks can be priced with this model. Common stocks cannot, because the dividends themselves are much more erratic and therefore riskier. Wow. Now, like I said, not every company issues them. Every corporation has stocks. There's no such thing as a corporation that only has debt, but those are all common stocks. Some companies do have preferred shares and some do not. And even the ones who do, it's a very small percentage of the total. Because it's just not that common. In other words, if you're an investor who buying preferred shares are looking for stable income rather than growth potential. Okay, that's the bottom line. People who own these shares, it's because they want the income. They might be retired, for example, and they really do need the income. Now, if for some reason the dividends paid by the perpetuity are growing at a fixed rate, which is not impossible. I mean, it's not unthinkable that the dividend could grow over time. If it grows at a specific rate, constant rate, which we call G percent per year, then the price will be this instead. Where G, as you can probably guess, is the growth rate. Now, we do have to be careful here. We have to make sure that R is greater than G for this model to work. Otherwise, we're going to have division by zero or something unpleasant. But other than that, this model could be used for cases where the dividends do grow over time, Although we're making a strong assumption here that the growth rate is the same every year, G%. So let's say, oh, and by the way, one of the implications of this is that if we start with D0, today's dividend, D1 is D0 times 1 plus the growth rate. Okay. And that means that in turn, D2 must be G1 times 1 plus G. And that in turn means that this equals D0 times 1 plus G squared. And so you can see the pattern that's developing here. And so that's one of the consequences of a constant growth rate. So, oh, by the way, it's important here to recognize that because the dividend is growing, that means it's no longer a constant. So we need to update this. We have to show that the price is actually equal to D1. Remember, P0 is today's price. D1 is next period's dividend. And keep in mind the D1, as you can see here, this. So we can write this as they both mean the same thing. And so this result is often called the Gordon after Robert Gordon invented it. You don't always, it's not always called that. It depends on the book. It's often referred to as the Gordon. And you'll see it has a lot of potential uses. It can be very helpful in a lot of applications. And oh, and by the way, we can update this to show that no matter what point in time we're looking at, time t, the price is going to equal the next period's dividend over R minus G. So let's say that we wanted to forecast ahead to the price at which we can sell the stock in year 5. All we need to do is use a forecast of D6 and divide by R minus G, and we're all set. All right, well, why don't we look at a numerical example? A stock pays a $2 dividend, and today's dividend is $2. And furthermore, the growth rate is expected to be 3% per year for the foreseeable future. And the required return to a specific investor is 7%. So that's our R. So that investor would look at a stock, this stock, and tell us that the correct price is so we have now. Don't forget, remember, it's got to be D1. They didn't give that to us in the prompt. We have to do that ourselves. So we're going to have 2, 3, 0.07 minus 0.03. So whatever that ratio is, 2.06 over 0.04, 5150. So if the price in the market is lower than that, then the investor would want to buy it. If it's higher than that, then the investor would want to sell it. Right? So from the perspective of this investor, the price should be 51.50. Now, for another investor with a different required return over here, they would have a different view about the value of the stock. But now, of course, you can rewrite this equation to show the expected return to owning that stock. So in other words, if algebraically, and we won't go through the steps right now because it's very late, but R would equal D1. This implies that R equals D1 over P0 plus G. And these two can be interpreted as the dividend yield, that's called. This is sometimes called a capital gains. This comes from the growth of the company itself. But that's where the return of the stock is coming from. Now, the company that doesn't pay any dividends, the return is just equal to the capital gains yield, meaning that what we expect the price, how much we expect the price to grow in the future. Now we have all these stocks, or maybe we're not so lucky. These assumptions are too strong. Maybe they don't have a fixed dividend rate. Maybe they don't have a fixed growth rate. Like I was saying before, what about a company that's in the early stages of its existence and the growth rate is very high in the early years and it slows down in later years? Or what about a company that doesn't pay any dividends in the first 5 or 10 years of its existence? I'm guessing that Amazon probably never paid dividends in the early years because, Amazon, surprisingly enough, considering how successful they are, it took a lot of years before they actually started making money. Bezos reinvested everything into that company. It was a good long time before the stockholders had any actual profits. So it happens. So there's the growth rate of the company depends on where it is in its life cycle, and the dividends depend on that. So we'd like to be able to adjust this model for these other cases. And luckily we can do that. All right. So let's look at an example of what I'm talking about. So a corporation has no dividends at the moment, but their expectation is to start paying a dividend of 50 cents in 4 years. All right, let's get this information together. So that means that these first years are 0. Great. The dividends growth rate, once we reach that point, will be 10% per year. The required return is 20%. The cost of equity, this is what investors expect to hold the stock. It's a fairly new company, then the rate of return is going to be higher. What's the price of the stock? Now, this is the model that will be used. This is the key to the whole thing. So if you were to draw out a timeline of the cash flow to the investor, nothing. And in year 4, we get a 50-cent dividend. And then the same year, D5 would be D4 times 1 plus the growth rate, which is 50 cents times 1 plus this G, 5 cents. Now, at the same time, though, if you notice the way this model is constructed, this means that we can tell what the price should be year four. So our projected price is 55 cents over, let's see, the horse, okay, 0.20 minus 0.10. And that works out to be $5.50. Because you're dividing, it's 0.55 divided by 0.10, which is equivalent of multiplying by 10. So what this is saying to us is that if we own this stock, we can expect that in 4 years we'll get a 50-cent dividend, and we can sell the stock for $5.50. Okay. So therefore, today's price is the present value of these two cash flows now. Of course, PV stands for present value. We were told that the cost of capital, cost of equity rather, R is 20%. So therefore, because these cash flows occur in 4 years, it must be the case that their present value is whatever that number is the price, the model price today. If the market price is different, we'll either consider it to be over or undervalued, and we'll make our investment decisions accordingly. $2.89. All right. So the model tells us that the price should be 289. If it's more than that, we'll sell it. If it's less than that, we'll buy it. Great. Now let's see. I think there's one more example here. Here we go. Now this stock is going to pay dividends, but they're not going to necessarily be equal to each other. So what are we looking at here? D1 is $1. D2 is $2. D3 is 250. And then after that, they're going to grow at a rate of 5% per year. 54 is D3 times 1 plus G. And that's 2.63, let's say. So let's create our timeline. Now, the price we can forecast in year 3 this time. So R in this case was, we forgot to write that down, didn't we? 10%. That works out to be 52.60. All right, so this is how we price this thing. Dividend year one is $1. We discount that by 1 plus 10%. The first power. Then the next year we get $2. Then we have 250. And then now in the last year we get two cash flows, the dividend of well, actually, I'm sorry. In year three, we get a dividend and the price is 52.60. So this one is also discounted for 3 years. Because both of these cash flows occur in the same year. All right, so I think those numbers have already been calculated in the slide. So let's take a look. It's approximately $43.88 when you add them up. And that's the model price of the stock based on this discounted dividend approach. All right, and I think they got one more thing for us here. Yeah, I mean, you've got this EPS model too, where you can say, listen, price per share equals expected. Yeah, we already saw this one, but we can forecast EPS into the future as current EPS times 1 plus the growth rate to the nth power. So if we have $2 per share growth earnings right now, which is expected to grow 4% per year, that means in 2 years, the earnings are expected to be 216. And therefore the price, because the PE ratio in this industry is 10, is projected to be 2160. And then if we have this cash flow, we end up with 23.6. Now, I see here that the CAPM model, capitalized pricing model, this is the most sophisticated of all the stock pricing models. This is the one that we want to spend a lot of time with. And I see it's getting very late. So my idea here is to save this for next week because we don't want to rush through it. It's awfully, awfully important. It also gives us our measure of risk for the stocks, the beta measure that I mentioned earlier. So this will save for next time. And when that's done, we'll be ready to start looking at derivative securities, which are very, very interesting, very exciting, but very complicated. So we'll stop here. And then next time we'll pick up the CAPM model. Okay. So I'll see you all then.
Thank you. Have a good night.
All right. Good night.
Thank you.
All right. Bye.